All right, well, look, Renny, thanks for joining us today. I'm actually really keen to delve into some of the topics that I've got on my little sheet here to talk to you about.
Mm-hmm.
Can you give me a brief overview of Arculus and what you do there?
So it's Arculus.
Arculus, yep.
So that Arculus was the Roman god of chests and preservation. So when we went searching for a name, several team members came when they went googling, capital preservation and those types of items. They came back with this name. I thought it was okay. We have our symbol is the key ring with the key attached to it that the Romans would wear to unlock their boxes, their wealth boxes, in ancient times. So it seemed appropriate. We had to find a name that no one else was using. It wasn't as easy as I thought it would be. So yeah, there's a whole story behind GCI Australia and the number of other firms that call themselves GCI. It was just getting to be a nightmare. So we're a fund manager, an absolute return fund manager. We manage money across 7 mandates now. 5 of those mandates are private mandates. And 2 of them are public mandates with retail access to them. They're the Arculus Preferred Income Fund and the Arculus Fixed Income Fund. All their details on them can be seen on our website. Our team is spread across the world a bit. We have one chap works out of the UK, one chap works out of Singapore. And we work in an office out of Sydney and Melbourne, which for a small team that's quite a good spread. But we never been really that worried with the internet and everything about where people worked. Everyone in the firm is senior, so we don't have a lot of junior people that require oversight.
Right.
In the firm, and where we do. Then there is somebody around to do it.
And was that a choice that you made as you grew, that you wanted senior focused people, or was it just naturally happen that way?
I think it started out that way, and it didn't really change. So we've been able to tap experts along the way to, senior people, managing partners of law firms previously that are, on the edge or basically retired type people. It has been the way it evolved. I think consciously, we probably would have gone that way anyway, but it did evolve that way.
Interesting. And you're a director there, but you're also head of investments.
Head portfolio manager. So underneath me, we have other portfolio managers on particular mandates.
Yep.
But on the 2 retail funds, I am the portfolio manager.
All right. And specifically bonds, right? I mean, you talk about money under management, but this is your specialty is bonds, yes?
Yeah. So the bulk of what we do is in the sovereign and bank senior bond area, mostly repo bonds.
Mm-hmm.
But we do have some mandates that go down to get some higher returns by adding subordinate and hybrid securities into the portfolio. But they are, yes, predominantly classed as a fixed income type asset.
And was this something that you'd always gravitated towards, or is this what you chose to end up doing because it was the best return for your investors?
The answer and the question sort of go together a little bit. So I have managed a portfolio for a very long time, about 30 years, an average return of 6.46% per annum. That portfolio is every security, every bond in it is A- or better rated. So highly liquid, sovereign and all bank senior bonds. So we came into this in 2011 with a great deal of confidence about what we could do in Bondland, given that history. And we've had another mandate that was started then that's returned. It's got some subordinate bonds in it as well in the mandate, and it's returned 7.1% per annum. So we have a lot of confidence about what we could do in the bond area. We're a big fan of the power of compounding returns for investors.
Right.
So 7% return is doubling your money every 11 years.
Yeah, and so do you find your investors, that's what they're using it for at that stage of their investment life, is that they're compounding, they're not using it for income?
The private mandates are definitely compounding. The retail mandates, no, the retail mandates use it for income.
Yeah, okay. Hence the two different funds.
Yeah, they different purposes. We're a source of liquidity as well. We take liquidity very seriously in the retail mandates, and yes, the income has been, and we like to pay out consistent income to investors.
Yeah, well, it's a good story when you do that, isn't it? I mean, it's a great thing, and investors always love being paid out, so that's good. So
it was a little bit challenging through the early part of the pandemic.
I bet
when bank bill swap dropped down and credit margins, bank credit margins were very low. We were looking at average major bank credit margins at around 50 basis points. Quite low.
As someone who may have a basic understanding of a bond, I mean, the difference between an equity and a bond is, well, essentially debt versus an investment of equity. But tell me about how you can trade bonds and whether because I read a lot of the documentation around how it's essentially actively managed portfolios. And that you actually use the forecasting and the market activities to deliver better than average returns, so to speak, for your investors. Can you delve a little bit into that?
Okay, so there's at an absolute return level, we have a macro down approach where we look at the economy and look at the direction of rates, as well as what the overall macroeconomic environment is telling us about potential default risk, credit risk, around an economic contraction. And so from a macro point of view, they're all important signals. We then also apply a bottom-up analysis approach where we look at the underlying issuers, and we look at them for two reasons. One, we want to assess value versus on a credit margin basis as to where they're trading in the market. So some might look cheaper than they will in a short period of time. Some might become an upgrade, and some might become a downgrade. Where people form opinions based on items that come through the media. We don't do that. We go in and do the analysis and come back with a firm in-house opinion. I could give you an example on that. We see a difference between Bank of Queensland and Bendigo Bank, but the market treats them at the same margin.
Right.
So we would place Bendigo on a lower margin to Bank of Queensland.
Right. Okay.
And there's several flags and methods and part of our credit analysis that do that. Another probably better example would be Macquarie and what was Suncorp. They had the same credit rating. Yet Macquarie traded inside the margin of Suncorp.
Right.
We would have viewed Suncorp as should be trading at the same margin.
Right. Okay.
How we trade? Most of what we do is in the over-the-counter market. So we trade with up to 6 external parties, major banks. And investment banks, both here and offshore.
And on that, so in terms of your portfolio makeup, is it all sort of public versus private bonds, what's the makeup there? I mean, is there much government bond related stuff? I saw there's infrastructure in there, but is that just government?
No, so in the Arculus Fixed Income Fund, that is only sovereign and senior bank and insurance bonds, APRA regulated bonds.
Yeah.
So that's all over the counter traded public bonds.
Okay.
We do very little in the private space. We in the Arculus Preferred Income Fund, about 7% of the portfolio would be private, could be considered at any time a private bond.
Mm-hmm.
But we don't do anything loan style, private loan style, anything like that. Every bond that we're in is Austraclear registered and can be publicly traded.
And that keeps the risk
Liquidity.
and the liquidity up and the risk down, right?
Yeah, well, I think the risk has got many elements to it. I wouldn't say that it's hard. That's an open-ended question,
Yes.
but it certainly enables a degree of liquidity.
Yeah.
In the portfolio, and we take pay a great deal of attention to making sure that the portfolio can manage liquidity in all circumstances.
Yeah. Okay. And I know from your documentation, liquidity was super important. I mean, with your charts there, with in a normal environment, the whole lot was liquid in 90 days, and in an extreme environment, 180, all that sort of stuff. So I see you put a lot of work into that.
It comes down to the size of the mandates. There are very big funds out there that have money flowing in and out every day. And so they have big inflows and they have big outflows every day. When you have a smaller sized mandate, then you have to you have to be a little bit more conscious of the fact that you're going to be trading in the underlying securities, underlying bonds.
Yeah.
So we're conscious of keeping part of the portfolio always in highly liquid securities.
Do you think in general investors put much weight into liquidity, whereas they probably should?
I think because it's been some time, even though arguably 2020 was a bit of a crisis, it came and went a little too quickly from some investors. And I think it's been some time since we've had an actual contraction in the economy where they've seen real default risk.
Right.
And so, yes, I think they're not paying enough attention to, one, risk, and two, the fact that liquidity will dry up. Yeah. We've seen a few examples of private credit style funds recently freezing redemptions.
Yes.
And that reflects the fact that the underlying assets that they hold are not liquid at all. It's not to say that anything's wrong with them or they're impaired, but they're just not liquid. So if a redemption occurs, then they can't just go in and sell that bond or that loan out.
Yeah. I think it's important. I think that liquidity is important. I mean, we come from the property side of things where property is highly illiquid. So, we see people where their whole investment portfolio is illiquid because it's all in property. And I think there definitely needs to be a balance. And one of the things that I really appreciated about when I was reading the documentation was about the focus on liquidity with a bond, which was perhaps sometimes perceived as rather illiquid in some form. And I think that to have that as a focus is rather important.
Well, there's a misconception here about liquidity. That there is people that go, it's ASX listed. If it's ASX listed, I can definitely trade it. But a bond, it's not ASX listed. I don't understand.
Yeah.
So a sovereign bond and a repo, a senior bank repo eligible bond, or even non-repo eligible once it falls below the 12 months, they are traded by our banking system all day, every day, as part of their capital management. So there is always an active market in all those bonds.
Yeah. We've got to have a buyer.
You have to go down into even in subordinate tier 2 bonds. There is a very active market, in those bonds. So, yeah, a major trading bank here would trade $100 million a day,
right,
in corporate bonds.
Yeah. Yeah. So there's got to be a buyer. I think people forget that just because it's on the market doesn't mean it's going to sell. And if it's ASX listed, it's still going to have a buyer for it. And I think that
Yeah.
that's part of the liquidity equation.
Yeah, so but also a bank senior bond has the other advantage in that they can be taken to the RBA repo window
Yes.
by a bank and moved into exchange settlement funds,
Right.
which are part of their high quality liquid asset requirements with APRA. So the banks are always actively going to be trading repo eligible bonds.
The bond market is rather large. And if you are purely an equities investor, you're probably aware of bonds, but might not realize the impact of bonds. What would you say is the greatest impact that bonds have on the overall market?
Bond values do definitely impact the equity market because the sovereign 10-year yield is considered the risk-free rate of return when doing analysis. So as the risk-free rate of return rises, the 10-year bond yield rises, that is then compared to the risk you're taking on as you move down a capital structure into equity, and the required return you need for that risk. So bonds definitely are the first starting point when pricing return risk for return, and that's why it's important. We have here in Australia our bond, not 10-year bond, is trading around 4.3% at the moment. And then even just looking at the state government bonds, they trade at a premium relative to the risk over and above the federal Treasury bonds, Commonwealth Treasury bonds.
Right.
And people need to understand then that, okay, so if you're sitting offshore, okay, I know I'm going to get 4.34 on a 10-year basis from Commonwealth level. I'm going to get, four and a half on a New South Wales bond, 4.6 maybe on a New South Wales bond. Then relative to that, what am I prepared to do with BHP? What am I prepared to do with Coles? What am I prepared to do risk return down to, something very illiquid and private. It all adjusts upwards according to the 10-year bond yield.
And is that rate, is it purely perceived risk of the bond, or is there also, there's a whole lot in there in terms of the time frame and in other market influences that dictate the appetite for the rate of the bond at the time?
Yeah, so that's represented, what you're talking about there is represented by the yield curve. And the yield curve moves to reflect the macroeconomic outlook. So at the moment, and really in Australia, all the way through since before the pandemic, we've had basically a positively shaped yield curve, where longer rates are higher than short-term rates.
Sure.
In the US, there was a period there in 2023 where we had an inverse yield curve, so short rates were higher than long-term rates. And at the time, the economic interpretation of that is that the US economy would have moved into recession by the March quarter of 2024. Now that didn't happen, and the bond market was wrong there to interpret it as a macroeconomic risk. It was actually the market was pricing the transitory nature of the inflation surge from the pandemic. Transitory is a little bit of a dirty word, given that central banks were using it and they then abandoned it. But that's actually what happened. And so the US yield curve is again now quite positive, and it's steepening almost every day at the moment. It seems to get steep, and our curve seems to get steeper and steeper. So it's indicating a positive economic outlook.
So you alluded to, and I'd read before as well, that when the bond curve inverts, it indicates recession. But that's not the first time. That's in recent times. It's happened a couple of times, and yet that hasn't happened. Does that mean that theory is just useless and out the window, or is there fundamental changes right now which mean that that's a little bit abnormal?
No, it's not out of the window. It's not fundamentally flawed. It was the yield curve. The US yield curve was distorted by the pandemic, and the actions taken in the pandemic. The stimulus provided both at fiscal level and at a monetary level. We didn't get an inverse yield curve here in Australia because of the way the federal government at the time handled it. In hindsight, I think we could say the Morrison government handled it very well. So we haven't had an inverse yield curve here, really for some time. We've not had a recession here since 92, 93.
The one we had to have.
The one we had to have. Well, yeah, the one we had to have. That's right. Yeah. So,
And
if we had a recession here, then, or if the market was starting to forecast that a recession was possible, then the first stage is a flat or neutral curve as a warning signal, and then it would turn inverse.
And in that regard, in your opinion, is the bond market better at predicting market activities of the future than the equities market?
I think in the US, you would certainly say the bond market is very, very good at making economic predictions. I don't know that could be carried away entirely over to Australia. Our bond market, we don't have as many players in our bond market as they do in the United States. So they've got a lot more participants, so they have much more efficient pricing. Here, we have some very big super funds. We have very big banks. Offshore investors tend to come and go a bit, depending on what their currency outlook is. So it at times, I would say that our bond market, is not as efficiently priced as it might be.
Right.
But it is still very important, particularly with the current level of government debt at federal and state levels. It's very important that the pricing and the yields on our bonds.
With that in mind, and the bond market effectively, predicting or a precursor to perhaps economic activities, in the past 3 months, let's call it, and what's happened in the US with the tariffs and what have you, the bond market seemed to react pretty quickly in that regard when there was all that talk of the tariffs and perhaps economic market conditions changing substantially. But the bond market seemed to give them a bit of a slap around, or was setting up to do that. Can you talk us through a little bit what happened there?
Okay, so there was a little. We had, prior to April 2nd, Liberation Day in the US, we had a clear indication from the new Trump administration that they were going to go in and with the Doge and Elon Musk's crew and the Doge, cut fiscal expenditure and look to bring the budget under control. And then, while that was still afoot, we had the tariff announcement, where very large numbers were talked about on day one. And the market added the potential impact of the tariffs to the fiscal contraction planned by the Doge, and there was a bit of a panic about the growth outlook. Separately, the tariffs, a general tariff at a country level, is inflationary.
Mm-hmm.
And we're now and so that was still there, but it would have been wrong for the markets to have said in isolation a tariff is negative for growth. We don't quite know how the US economy would react to the tariff. We don't know how corporations would react to the tariff, and we are still going through that because the level of tariffs and the date at which they apply has been a bit of a moving feast.
Yeah.
The markets rallied very quickly in April once they realised that the Trump administration wasn't actually going to engage in fiscal contraction, and the big beautiful tax bill was basically fiscally expansionary.
Yeah, it sure is.
That's why the equity market's gone to record highs, but the bond market is still very worried about it. It's not apparent in the 10-year yield. The US Treasury is preferring to issue shorter dated and longer dated 20 and 30-year bonds and staying a little bit away from the 10-year Treasury. And so the 10-year Treasury has been somewhat stable, call it 4.3 to 4.5% last few months, roughly. But the 20 and the 30 year, they're pushing up through 5%. And that's where they were in October 2023, when we had potential dislocation between German and Italian rates going beyond the 200 basis point limit, and we had the trust budget issues at the time.
Yeah, well, that's interesting. So, because the bond market slapped around Liz Truss, right? I mean, some of the things that they were looking to do in the UK, and I was wondering how that went across in the same way to what Trump was verbalising he was going to do.
Well, it might well do it, but what interesting thing we've got occurring at the moment is not only have we talked about tariffs, and some have been implemented already, we've also had a weaker dollar. Right. So tariffs would not be inflationary if the dollar strengthened the way it did in 17-18 when Trump last brought in tariffs. If it strengthened, but it hasn't; it's weakened. Right. So that is accentuating the potential inflationary impact of the tariffs. So we think that the dollar has taken a lot of the pain and the punishment so far, the US dollar, for Trump's approach to, or the Trump administration's approach to economic policy. And I think it's too early to make broad-based conclusions on whether these policies are going to be good for the US economy or not. Mm-hmm. But they certainly look like they are inflationary.
And will they be inflationary here as well?
Their policies on us, no.
Okay.
No, but we'll track our long end of the long end of our curve, the 5 to 10 year part of the curve, tracks changes in offshore bond yields.
Yeah.
So if their bond yields go higher, ours will go higher with them.
Well, on that note, I mean, you mentioned that the 10-year US, I think when I looked at it, was 4.25 currently. But when I looked at the next bond offering for the Australian Office of Financial Management, the 10-year was 2.75. So there's a 1.5%.
No, that's not right.
That's not right. So what is the Australian office?
Our 10-year trades. It's currently trading at about a 10-point discount to the US 10-year.
Right.
So the US 10-year last night closed at 4.32. Our bonds would have opened 4.22 here, roughly.
So that
figure, we have at times traded at a premium.
Yeah.
When the Albanese government was first elected, our 10-year went to a 75 basis point premium in June 2022.
Yeah.
To the US. And that premium was just too large, but it reflected the uncertainty of what the new government would do with policy. And as that uncertainty receded, that margin contracted, and it's now trading at a discount.
And we're normally at a discount to the US?
No, we're normally at a premium.
Yeah.
We're normally at a premium. Again, it's about a 15 basis point plus or minus the US.
Yeah, right.
In normal circumstances, and that would reflect normal demand and supply.
Let's talk about inflation, because you mentioned it a couple of times, and I know you sent me some stuff to have a look at. And the second document you sent me was actually the most intriguing, because one of the things I really like reading about, which is relating to monetary policy, which I don't know, maybe there's a few of us in the world that love reading about monetary policy, and maybe there's two of us on the call right now. But essentially, the way that I liked how it was put in the document, with the two different aspects to either believing that monetary policy is inflationary or it's not. Can we just touch on your thoughts around that?
Okay, that's a bit of an open-ended question.
Yes, I know. So let's go. Let me clarify. So the two trains of thought are that government-induced policy either causes inflation or it causes, I guess, market action, which doesn't, in fact, affect inflation. If I've got that right, essentially, it's either it does or it doesn't affect inflation.
Okay, so Keynesian economic theory. And John Maynard Keynes, the idea was that you used a fiscal expansion during the times when the economy was underperforming. And how do we define that? We have unemployment well above the considered full employment level, which in Australia is 4.75.
Mm-hmm.
So at a time when we have unemployment running at 5 and 6%, then Keynesian theory would say this is the time to do a fiscal expansion. There's no inflation or very limited inflation implications of fiscally expanding because there's surplus labor and supply.
Yes.
And if there's surplus labor and supply, then they won't be bidding up wages, and higher wages cannot afford higher prices, and so inflation. That's the connection there.
Yeah.
What we have at the moment is we have fiscal expansion at state and Commonwealth levels occurring at a time when we're beyond full employment. In fact, we're well beyond full employment. We're arguably somewhere between 4 and 4.25%. I know the last reading was 4.3, but when you look at the average over the last few months, it's roughly there.
Yeah.
We're well within that. And we've still got fiscal expansion occurring. Wages growth is running at around above 3.5%, not below 3.5%.
Yeah.
Which is not consistent with an inflation outcome of around 2.5% when we have negative labour productivity. So we have underlying pressures in the economy still, from a Keynesian point of view, of inflation coming in the future. On a monetary theory connects the money and supply with the velocity of money.
Mm-hmm.
We don't actually measure money velocity in Australia. We do in the United States. Not a strong believer in monetary theory here. But monetary growth is still running at around broad money growth is still running at around 4.5%, which again is not consistent. Even if money velocity was still declining, it's still not consistent with achieving a stable inflation outcome. I'll give you that a little bit more detail there. In contrast, both the US and the Euro area with the ECB, they achieved a period in the last post the pandemic of negative broad money growth.
Yeah,
it was only a short period, but they did achieve it with monetary tightening, and we did not do that here.
No, it seems not from the charts. And negative broad money growth should not be confused with deflation, right? Because if we're talking about that way of thinking, then what we're saying is restricting the supply of money, therefore the activities should be restricted, and therefore inflation will come back into order.
Yes.
That's correct?
Yes.
Yeah, right. Yeah. So in this instance...
Households are getting a higher rate. There's less money in supply, higher interest rates. Households are encouraged to save and not spend.
Yeah, right. So that's the controls. But what we're seeing in Australia is that we've got that lower than full employment of 4.75%. So we've got more employment. Therefore, we don't have people fighting for jobs, so to speak. And yet we've still got stimulus happening. Therefore, the way that we're seeing it is inflationary activities is still going on.
And more to the point, that's there too. But I'd also make the other point that because of the size of the fiscal expansion that's been ongoing, is that there really isn't anything there in case there's an external shock.
Yeah.
A breakdown in trade with China would be a huge external shock to Australia for whatever reason it occurs. Another pandemic and a huge external shock that would occur. There's nothing there that Australia could do really to defend itself, because it isn't saving money during times when the economy's operating at or beyond full employment, and it probably should be.
And you're talking about the household saving money, or are you talking about government saving money, as in?
I was talking about governments in that context.
Yeah.
Australian households, we don't have a terribly good household savings ratio at the moment. As we came out, at the early stage of the pandemic, the actions that the government took, locking us in our homes and everything, the household savings did increase very sharply.
Yeah.
And at the time, RBA Governor Lowe kept on pointing out that the economy would pull through this because the savings ratio was so high, and that was true.
Yeah. Yeah, no, that's interesting. So um, the connection with what we're talking about with monetary theory and then modern monetary theory, because chuck a modern at the front of it just to make it sound better, would be that, well, if governments actually had a surplus, then they've taxed us too much, so therefore they shouldn't tax us, or they should either spend it or not tax us as much, because that's my money sitting there and it should be in my pocket.
Yeah, I'm not sure. I'm not sure I'm making that connection. So, um, modern monetary theory is is Keynesian expansionary theory taken to another level, where they're not constrained by the level of government debt anymore. They're not worried about running a balanced budget, or getting the budget back into balance at some point in the
Correct.
economic cycle, so that they are ready for the next um, external shock in the economy where they need to expand fiscal expenditure. Modern monetary theory says, well, if we keep increasing the budget deficit, we can just keep funding it by issuing more bonds, and we'll get the central bank to buy the bonds and sit them on their balance sheet. So effectively, money and supply just keeps on increasing.
Yes.
Debt keeps on increasing, and it has. For all those first things, the government, since Obama started doing this, governments have got away with it because inflation has been being exported basically to Asia.
Right.
Principally China, but rest of Asia as well. And so over that period, between 2009 and 2020, we had what Summers called secular stagnation, where inflation really didn't move. It was stable, and some cried that it was too low, but it was stable. And in that period, whenever there was the central banks had the luxury of, yes, increasing the money supply and letting the governments keep spending, but they also had the luxury of, whenever they thought the asset prices were under pressure and were falling very rapidly, they were able to pump in liquidity very quickly. And so during that period, we saw official rates in most of the developed world move in a 200 basis point range. That all changed in March 2020. In March 2020, we got inflation back. The inflation genie had escaped from the bottle, and it's not back in the bottle yet. It's near the bottle. It's bottle adjacent, if you like, but it's not back in the bottle. And we know it's not back in the bottle because we still have wages growth at 3.5% here. So there's that. The second thing that happens, though, with modern monetary theory, and the governments increasing their debt and increasing their expenditure and never actually pulling it back into line during periods when the economy is strong, is that in time, the government expenditure is crowding out private sector involvement in the economy.
Yes.
So we become a much bigger government bureaucracy, government responsible for a lot more of the factors of production in an economy, and businesses, not just for regulatory reasons here, but just because of the accessing money, capital for funding, and accessing opportunities, they're just not participating as much as they were. And arguably, you'd say that's what's the situation that France is in at the moment. Right. France has got a debt problem, and its government is too big. And the next shock, you mentioned trusts, but the next shock may well come from France, not the UK and not the US. Maybe France has to answer to the bond market there.
And in terms of exporting your inflation to China for that decade or so,
actually, we started a lot earlier than that, but it's the decade of secular stagnation that counts. Yes.
And I mean, how does that? Is that just effectively because you're buying product at a cheaper price? Like, how can you? I mean, I know it's a term, right?
So China had cheap labor.
Yeah.
And it was able to manufacture finished goods, particularly household goods, cheaper than the United States and Australia and everywhere. And so we were effectively shutting down our industries in these areas and importing the same product from China.
Yeah. So in essence, it really was putting it on a boat and sending it over there, because that's all the manufacturing went over there.
And that's why the inflation shock with the pandemic was so immediate. Because that part of the supply chain was closed straight away.
Yeah.
There was some work done by Fathom Economics on this, and they said that the impact on shipping prices, freight costs, the Baltic Freight Index, was quite immediate into inflation.
Right.
But also just the fact that for a while there wasn't much being exported from China.
Yeah, it's interesting because we've got a client who is based in Singapore, and his business is they invest into and own shipping containers. He goes, I can track every shipping container all around the world, right? They got untold numbers. And it was very interesting talking to him at this time because they could see the containers just stopping. They weren't moving around. This and happened, and all the flow-on effect of when things started up again, and then there was this forward planning of containers need to be here and there. So the shipping was really impacted, and obviously was one of the first things that brought on that extra cost in the inflationary side of things.
Yeah, it didn't also help that we were all locked in our homes and the government was pumping in money, through welfare and other methods. So we were still able to keep spending. What were we going to spend on? We were going to spend on durable goods,
online,
TV, all that sort of thing.
Yeah.
And so we had the initial inflation shock came in durable goods, and then it's translated now into services inflation.
Yeah. So you made a mention of with the concept of MMT and the central banks issuing bonds, and then rebuying bonds and what have you. How does that affect the bond market? Like if the government is kind of issuing and rebuying their own bonds, does that have any impact on what you're doing for your investors and how you view the market?
You get away with modern monetary theory when we didn't have an inflation problem.
Yeah.
You're not going to get away with that when we have an inflation problem now. So all the central banks are trying to pull back their balance sheets at the moment. And so because they don't want to keep, it flies against what they're trying to achieve in controlling inflation if they're at the same time providing monetary stimulus through buying bonds in the market. So they're all pulling back. It does impact us in that it impacts the shape of the yield curve,
right?
And the direction of rates overall, and how we trade it. At this stage, it doesn't. We would need inflation, so we've passed through the transitory period with inflation, and what we get now, if inflation starts rising again, it'll be cost push inflation. So it'll flow from the higher wages into higher prices, so cost push inflation, like what we saw in the late part of the 80s.
Right.
If that starts to occur, then we've got two problems. One, we've got fixed yields rising, and that's not good for fixed yield holders. But we also get this increasing default risk. As rates go higher, it puts a lot of pressure on private companies' cash flows, and we'll start to see an increasing risk of default risk. From a bond trading perspective, you see that in an expansion of the credit margin. So you've bought a bond at 90-day bank bill swap rate plus 100 basis points.
Yep.
Probably a major bank bond on a 5-year basis, and then there's the economic outlook deteriorates. That bond could then be repriced at 120, 130 basis points. So that move, a 50 basis point move, is probably worth 4%, roughly a 4% change in the capital value of the bond.
Sure.
So it is important to understand where the economic outlook is going.
If you want to touch on that, because some of my viewers are property people and there's a portion of them are commercial property. So when I was looking into bonds, a while ago, I come from a commercial property background of pricing with yield versus cap rate. And that's kind of how I got to understand the bond side, which is probably a really bad way to do it. But essentially, you buy a commercial property on a yield, but you sell it on a cap rate. And it's a similar thing when I look at the bonds. If we bought it on a bond rate at a certain amount, then but the bond rate changes, then it drops the value, which is what you're alluding to here on the capital value of the bond. How do you go about trying to forecast and measure that for your portfolios? Because that's obviously a pretty complicated thing to try and work out.
Yeah. So again, it just comes from the doing the proper macroeconomic overlay risk to see where bank bill swap rates are going.
Yeah.
And at a peak in what we consider the interest rate level, then you'd switch towards fixed rate bonds.
Yeah.
But as the economy is expanding and as bank bill swap rates are rising, you'd be staying in floating rate bonds. From a bottom-up perspective, it's important to understand how all the issuers, the companies, issuers, banks are all traveling and what their actual results are telling you about the risks and the way the economy is operating. So that's important too.
What is your view on the bond market telling you which direction interest rates are going? I mean, I know we've talked about, the money supply, MMT, all that sort of stuff, but is there a way that the bond market says, look, we think that interest rates are going up, or we think they're going down or stable or whatever?
The market is pricing with bank bill swap rates 90 and 100 days at the moment forward. The market is pricing another 2 interest rate cuts this year.
Yep.
With a fairly high degree of certainty. They're about 100% in August. The 2-year bond rate is then saying that rates will then start to rise.
Right.
And the 5 and the 10-year are telling us, in time these rates are going to be higher, not lower.
Yeah. Right.
From there. So yes, the outlook is there's not a lot of risk or probability of rates falling as much as in the longer term rising.
Yep. Okay, that's interesting. And then you take that information and you do your, macroeconomic stuff, magic for what you do behind the scenes, and that's what helps you build portfolios for your investors.
Yeah, the macro overlay is very important. We need to be able to know where bank bill swap is going to go. But I must stress that the bottom-up analysis is also very important. We have to be able to price credit risk at an issuer level.
Yeah, okay.
Just very, very, very important.
And in terms
of the AAA sovereign risk-free rate of return impacts the whole economy, and that's why you need to be knowing where that's going to be trading.
Well, and that leads me to one of my final questions is bond market outlook for this year and beyond. I mean, is that simply already priced in with what we're talking about now? There's these price points of 30-day, 90-day, 12-month, 5-year, 10-year. I mean, they're priced in now, but is there other activities you see perhaps going to impact the bond market, which is affecting the decisions you're making for the portfolio moving forward?
Well, so at this stage, the nature of the Australian economy, we don't, unless there's an external shock, we don't see much risk of an economic contraction. We don't see much. Government spending is still very strong, and we don't see much at risk of an economic contraction. So the risk for us is on inflation rising and beginning to rise once again. And one of the key reasons that this may happen is that the electricity subsidies which began in Tasmania in February, March 2024, and have only just now expired at a federal level, but all states use them to varying degrees. Those electricity subsidies have now expired. So we're going to see, and the Reserve Bank governor pointed this out, we're going to see higher inflation anyway over the next 6 months coming through. So we think we're not expecting. We would put a decent probability anyway on the Reserve Bank not actually moving rates at all, but remaining on hold. One of the things I'd really like to point out is that the RBA has been very good with its modelling of the economy through the pandemic and predicting that a lot of these inflationary impacts from the pandemic would be transitory. That has proven to be correct. They didn't move rates up or contract the money supply nearly as much as they did in the US and Europe.
Yeah, right.
And it was a good call. And equally, then I'd say that there's less need for them to drop rates now.
Yes.
They can be patient here for some time and see how things pan out.
Interesting. Renny, thank you very much for joining me today. It's been an absolute pleasure. I've learned a lot. And if there's one thing with someone going to start out in bonds now, say they're coming from equities and they say, look, I've got a portfolio, but I've never really considered bonds. Can you give me the top 1, 2, or 3 tips that they should be looking for when they're going to start out in bonds?
I think the biggest mistake that you see made is that they combine corporate risk with fixed interest risk. You buy a fixed rate bond. You don't buy a fixed rate corporate bond at the same time, because a fixed rate bond will benefit from the economy deteriorating and interest rates falling and the yield curve falling.
Right.
But at the same time, that will mean a higher margin on that bond is required by the market pricing the risk of default.
Yeah.
So what you get, you end up with a corporate bond, call it, I don't know, XYZ issues a corporation issues a bond at 5%. You end up seeing that the credit risk offsets the potential benefit from the fixed rates falling. That's a really big mistake people make. The second mistake that they make is not diversifying. Bonds are about risk. You want to minimize your risk as well for your return, because your return is capped with the yield. So you want to have a bond portfolio which has got a decent spread of investments, not just one bond.
Yeah, that's a good call. Good call. Well, Renny Ellis, thanks for joining me.
Yeah, thank you.
Yes. Everyone, that was Renny Ellis from Arculus Funds Management. And if you're just catching up at the end, make sure you go back at the beginning and watch all the stuff that Renny's got to say. He's got many years of experience in the bond market, and I found it very, very interesting to talk to him today about all aspects of bonds that we covered, including some things like political influence in policy and MMT and all that sort of stuff. So make sure you catch it up. Thanks for joining us.